Hi, I'm Beth Davies, president of Taxes Untangled. We're a CPA firm operating in Ocala and Gainesville, Florida. This is the second part of our series on entity selection. We're going to cover partnerships. To form a partnership, all you really need is to have more than one owner. You don't even have to have a written agreement. You just need to you should have written down how the operations of the partnership are going to work. How you get into the partnership, how you get out of the partnership, what happens if somebody dies, how the profits and losses are allocated to the different partners. All of these things can be variable depending on the needs of the different partners. Hopefully you watched the first part on sole proprietorship, but I'll cover some of those things in this discussion anyway because it's important. With a partnership, you're going to need to get a federal ID number, an FEIN. You'll hear that term quite a bit once you're in business. You'll need this number for filing the partnership income tax return, and if you have employees, the quarterly payroll tax returns. As I alluded, you will be filing a partnership annual return with IRS. This reports 100% of the revenue and expenses of the partnership and is then allocated to the different partners, and that's how it becomes a flow-through entity. All the profits and losses flow through to the partners, and as I referenced, it all depends on your partnership agreement at what percentage. It doesn't necessarily have to be based on your ownership percentage. So that is one of the benefits of a partnership. It gives you some flexibility. The partners can be individuals, LLCs, corporations, S corporations. The partnership is quite flexible. There are also limited liability partnerships. That's a little beyond the scope of this, so we're not going to go there. One of the downsides of partnerships are that the partners can be held jointly and severally liable for the actions of the partnership, which means if you own 10% of the partnership, you can still be held 100% liable for any potential liabilities. That if you're the money partner of the partnership, that is where you're going to potentially be hurt, is that you can be sued individually for the partnership liabilities. Another part of a partnership is that you are going to be paying self-employment tax if you're working in the partnership. All of your profit from the business will be subject to the self-employment tax, which is 15.3%. That's the Social Security and Medicare tax. So if you have profit of $100,000 and you are the 10% owner, you get profit, in this example, of $10,000. You will pay self-employment tax of $1,530 for that income, as well as paying income tax. Again, this was a brief overview. I recommend that you hire an accounting and tax professional. It's always a good team to put together, and while you get information from Google or other internet sources, they're not always accurate or up to date. Thank you.